Foreign institutions with $50 billion still lose to patient Indian retail traders on Dale Street. Big funds control order flow, but they cannot buy the freedom to wait. Most individual investors never realize they hold an edge that money cannot duplicate. Even the largest LIC funds bow to quarterly redemption deadlines during market corrections. Understanding this structural trap changes how you view your portfolio starting today. Big funds move 1,000 crore rupees in seconds while small traders watch in real time. Institutional research teams visit company factories before retail traders get news alerts. High-frequency algorithms complete transactions before you can click the buy button. Solo investors struggle with anxiety while funds execute trades through emotionless software rules. Yet competing on their terms is a trap you can easily avoid. Short-term intraday trading pits small accounts directly against institutional fiber optic servers. Algorithms exploit microsecond delays to extract profits from every retail buy order. Because institutions set short-term prices, retail day traders face negative expected value. Trading daily noise guarantees paying fees to institutions while absorbing maximum market friction. Step off their short-term racetrack to see where their armor cracks. Usain Bolt wins every 100-meter sprint, but he fails in a 42 kilometers marathon race. Institutional funds build speed for short sprints, making them vulnerable over long horizons. When you extend your horizon from 90 days to 10 years, institutional speed becomes irrelevant. Long-distance endurance favors unencumbered individual investors who do not report to bosses. Changing the length of the game unlocks your true market advantage. Individual traders hold complete freedom to hold stocks through temporary market pullbacks. No angry clients will call you demanding cash returns during a temporary market correction. Holding cash or equities without permission slips is a privilege fund managers envy daily. Time acts as an equalizer whether your account holds 5,000 rupees or 5 crore rupees. India's greatest industrial builders built fortunes using this exact long-term principle. Ratan Tata proved that industrial giants thrive by ignoring short-term quarterly market noise. Mukesh Ambani invested billions in telecom infrastructure years before Reliance Jio generated revenue. True wealth creation requires backing solid businesses through extended gestation cycles. Individual investors can match visionary founder patience without answering to institutional boards. Yet traditional Indian households already apply this exact patience to physical assets. Indian families hold ancestral gold and property for decades without checking daily prices. No one sells land in panic simply because market news reports a quiet quarter. Treating shares of great Indian companies like physical gold transforms portfolio outcomes. Daily ticker tape updates distract investors from business expansion and profit growth. If holding stocks is so simple, why do most retail accounts overtrade? Boredom drives retail investors to trade unnecessarily, surrendering their greatest strategic advantage. Constant app notifications trigger action bias, making patients feel uncomfortable and lazy. Switching positions frequently burns capital in transaction costs, brokerage fees, and taxes. While retail investors discard patience voluntarily, institutional managers lose patience by strict mandate. Looking inside fund manager contracts exposes why institutional money moves under heavy chains. Mutual fund managers manage other people's money under rigid regulatory rules and constraints. Underperforming the Nifty 50 benchmark index for 2 quarters risks manager career safety. Client mandates force managers to follow market consensus rather than taking contrarian positions. Institutional money managers trade with watches on their wrists, constantly tracking evaluation cycles. Quarterly scorecards turn fund managers into short-term survivalists against their will. Panicked fund clients pull investment capital precisely when market corrections create value. To process client redemptions, fund managers must liquidate great stocks at rock-bottom prices. Knowing a business will double in 5 years cannot save a manager facing immediate redemptions. Forced liquidation during panic selling destroys institutional performance while handing opportunities elsewhere. Internal rebalancing rules trigger forced institutional selling even when market outlooks remain strong. Rigid allocation caps force mutual funds to sell top-performing shares during market rallies. If a stock exceeds 10% of portfolio value, compliance rules require immediate partial liquidation. Institutions dump their strongest winning companies because regulations demand mathematical rebalancing. Because funds must sell winners, compounding momentum gets artificially severed by mandate. Automated risk management systems trigger additional selling when prices hit strict percentage floors. Risk management algorithms trigger mechanical stop-loss orders when share prices drop 15%. Computer systems sell institutional holdings automatically without evaluating core business quality. Temporary market volatility turns into cascades of forced institutional selling across Dale Street. Institutional managers operate like puppets tied to regulatory, client, and algorithmic strings. Recent market history shows exactly how these institutional cascades create massive retail entry points. Massive foreign institutional investor outflows created heavy selling across Indian equities recently. Currency fluctuations and foreign mandates forced funds to sell quality Indian blue-chip stocks. Fundamental company earnings remained excellent, yet prices dropped due to pure fund liquidation. Patient individual investors bought these discounted shares while institutional managers were forced out. Before examining compounding math, let us pause to share strategies together. If you have effective investment insights beyond this video, please share them in the comments below. Liking this video helps reach ambitious investors across India seeking financial independence. Subscribing guarantees you will receive upcoming market analyses on institutional trading behavior. Are you investing unencumbered personal capital or money needed for near-term expenses? Understanding capital freedom unlocks the mathematical phenomenon that creates generational wealth. Uninterrupted compounding works like a rolling snowball, accelerating growth exponentially in later years. Investing 10,000 rupees monthly yields modest gains early, but explodes after 15 years. Interrupting the compounding process forces your investment curve back to starting line zero. Because institutional funds sell periodically, they miss the steep back end of compounding curves. However, holding stocks blindly without checking business health turns time into a dangerous trap. Patience becomes financial poison when applied to dying businesses with declining revenue streams. Holding failing companies through structural industry shifts permanently erodes investment capital. A sinking ship does not recover simply because an investor decides to hold for 10 years. Averaging down on structurally broken businesses turns time from an asset into an enemy. Evaluating basic financial metrics protects your portfolio from stubborn value traps. Focus on consistent profit growth rather than market hype or social media speculation. Companies expanding cash flow annually protect your capital through every economic cycle. When earnings rise consistently, temporary price dips offer attractive long-term entry points. Relying on hard balance sheet data eliminates emotional guesswork during market pullbacks. Applying these criteria leads directly to 3 practical rules for retail market success. First, refuse short-term trading and play exclusively in multi-year investment gains. Second, invest only surplus capital that requires no withdrawal for at least 5 years. Third, buy shares in quality businesses when institutional mandates force big funds to liquidate. Following these 3 principles removes institutional advantage and establishes your market dominance. Knowing how to capitalize on institutional distress turns market panics into personal opportunity. When big funds dump solid companies due to quarterly pressure, retail investors gain prime entry. Distinguishing between business decline and institutional liquidation is where real fortunes originate. Purchasing great businesses during forced selling events locks in superior long-term yields. That's why structural market freedom remains the true separator on Dale Street today. Mastering this edge changes your financial trajectory across the coming decades. Institutions possess capital, speed, and research, but you hold complete freedom over time. Stop competing on institutional speed tracks where algorithms dictate short-term pricing. By holding quality companies patiently, you force big money to play on your terms. Wealth on Dale Street ultimately flows from impatient capital to disciplined individual investors. Will you keep chasing short-term noise, or step into the long-term arena?